April was a strange month. Oil surged, inflation fears came back, war risks escalated, and yet somehow markets rallied hard anyway. The S&P had one of its strongest months in years. So here's what's happened and how my portfolio responded. With all this going on, my portfolio gained 3,000. This is broken down into contributions of just over 400 and then market moves which added 2,500, which works out as adding 0.3% to my portfolio value. My portfolio is super steady at the moment. It's positioned very defensively, and so when markets go up a lot, it doesn't go up a lot. When markets go down a lot, it doesn't go down a lot. And this month, global equities just ripped higher, up 7.5%, which is strange considering all that's happened in this month. And with oil prices this high and equity markets this high, one of them has to be wrong. Either equity markets need to fall and catch up with oil prices, or oil prices need to fall in order that these valuations make sense. But at the moment, equity markets are just happy to keep going up no matter what happens or how expensive they are. But I don't believe that can continue forever. And I think currently people are taking a lot of risk in equity markets for not much upside. Inflation was significantly higher this month at 0.8%. The benchmark for my portfolio is inflation plus 3% every year. I don't benchmark my portfolio off global equities. Rather, I'm just trying to beat inflation by 3% per year. And if inflation stays this high for a long time, interest rates are going to have to rise significantly, which will mean that equities are going to struggle to keep at the levels they are at. In terms of what performed well this month, the best performer was Trojan Fund. Trojan Fund is a wealth preservation fund. It aims to give positive returns no matter the market it is in. And roughly it's positioned a third in equities, a third in inflation-linked bonds, 10% in gold, and the rest in cash or bonds. Over the course of 2026, it's been up 3%, down nearly 3%, and is currently roughly flat for the year. The worst performing investment this month in my portfolio is the Argonaut Absolute Return Fund. It is a super aggressive long-short fund managed by Barry Norris. It's been up as much as 12% this year and down as much as 7%. So it's quite a volatile fund, but it's only 1% of my portfolio. The fund manager takes some really interesting positions. So currently 20% of the fund is in Eastern European or Greek banks. It will be really volatile, but long-term returns are good, and it won't move in the same way that equity markets do. With all that's happened in the world and with how defensive my portfolio is positioned, my portfolio has actually done really well this year. It's up 6.8%, which is a really good return for quite a defensive portfolio. It's even currently beating global equities, which are up 5% this year, but with way less volatility and taking on way less risk than currently are in global equities. And it's currently easily beating the benchmark of inflation, which has only actually risen by 0.7% this year, although I expect it's going to be much higher by the end of the year. In terms of buys and sells this month, there hasn't been much activity. The biggest change is selling out of the iShares index-linked gilt ETF and buying into the Capital Gearing UK index-linked bond fund. The reason for that is to decrease duration risk. So I want exposure to UK inflation-linked bonds. UK inflation generally runs higher than US inflation, and I've got lots of exposure to US tips, but I want to keep exposure to UK linkers. However, the trouble with UK linkers, and particularly the ETF, is that the duration is very high. Currently, it's 14.5 years, which means that if interest rates move, this bond ETF will move significantly. I'm quite worried about interest rates staying higher for longer, for inflation to be higher, and also for government debt sustainability to be questioned by markets at some point. And so swapping the ETF, which has a duration of 14.5 years, and buying the capital gearing fund, which has a duration of 5.9 years, just decreases my risk and will mean that I track inflation a little bit closer and don't track long-term interest rates or long-term bonds, which can be very volatile. In doing this, I also increase my exposure to index-linked bonds by selling some cash and putting 2.5% into the capital gearing index-linked bond fund. So this is what my asset allocation looks like. Cash and short duration is 39%. This is made up of primarily money market funds and a short duration gilt. Inflation-linked bonds are now at 32%. These are primarily short duration, US tips, and a little bit of UK linkers and global inflation-linked bonds too. What I've called defensive and absolute return is at 24%. This is a bit of a catch-all category for hedge funds, long-short equity funds, and wealth preservation funds like the Troy fund I spoke about earlier. The aim of this is to protect capital when markets are falling, but also to give a little bit of upside when markets are rising. And finally, I have just over 4% in gold. This portfolio is defensively positioned. It's not going to go up as much as global equities if they keep rising, but also when global equities fall, it should stay very, very stable. The aim is that when equities become more favorably valued, I will transition this portfolio into a much more aggressive portfolio with a lot higher equity exposure. But if the CAPE ratio is going to stay at basically dot-com bubble level, then I just don't think the risk and reward is there to be fully in equities at the moment. Or with my portfolio, even a little bit in equities. I think there will be much better opportunities to invest in equities in the future when risk and reward are a lot more favourable and equities are a lot cheaper. And I'm just happy to be patient and wait for now, even if that means missing out on some returns. My top 5 holdings haven't really changed. I've slightly reduced the money market fund Amundi Smart Overnight Return to buy, as I said earlier, the UK inflation-linked bond fund. Other than that, nothing else has changed this month. April has been a bit of a strange month, and I wonder how your portfolio has done this month. Please follow along as I'll give monthly updates next month and we can see what's happened with markets and my portfolio then.